Good evening, everyone. While crypto markets spent 2025 debating whether Bitcoin's 4 year cycle was ending, central banks and institutional players executed the largest coordinated financial infrastructure replacement in modern history. The rewriting happened in silence. The structural implications are only beginning to be visible now in 2026. Fidelity Digital Assets published their 2026 crypto outlook with a thesis that challenges conventional market analysis. After President Trump's executive order that established the strategic Bitcoin reserve, crypto markets celebrated adoption while missing the structural transformation this represented. Fidelity frames this as a paradigm shift where crypto transitions from speculative volatility to legitimized store of value backed by government mandate. The firm identifies this as the beginning of what they call institutional phase two, where crypto's role changes from asset class to infrastructure component within traditional finance. This isn't about price speculation anymore. It's about crypto finding its place within the existing monetary architecture, not replacing it. What makes Fidelity's analysis particularly relevant is their observation about game theory among nations. If more countries adopt Bitcoin reserves following Trump's executive order, competitive pressure forces other nations to follow regardless of ideological opposition to cryptocurrency. Now, Fidelity explicitly states that any additional demand from foreign buyers pushes price through simple supply and demand economics. But the more profound implication is that Bitcoin becomes infrastructure for institutional reserves rather than a speculative asset. Now, there are over 100 publicly traded companies that now hold crypto on their balance sheets, with 50 firms controlling over 1 million Bitcoin collectively. This represents a structural liquidity provision mechanism where corporate treasuries effectively are becoming market makers, smoothing the volatility through their balance sheet positioning. Okay. Wall Street broker Benchmark published an analysis on January 12th of 2026. They identified the current week as potentially pivotal for digital assets. Now, this is driven by expected Senate action on crypto market structure legislation. According to the benchmark's assessment, clear regulatory framework would end crypto's US regulatory limbo and it would unlock institutional liquidity currently that's basically just sitting on the sideline. This connects directly to reports that Morgan Stanley is leading what markets are calling round two of institutional adoption. This is basically where crypto enters a second structural phase. This is distinct from the initial speculative phase. Let me break this down. The second phase, or the first phase, that's where we saw institutions basically dipping their toes into crypto as an alternative asset. But this second phase, this involves institutions integrating crypto's infrastructure into traditional financial operations, custody, clearing, settlement, and payment rails. Now, the structural difference it matters because in round one, institutional adoption was about exposure to crypto basically as an investment. But round two, this adoption is about utilizing crypto infrastructure to improve traditional finance operations. Now, Morgan Stanley's wealth advisors are offering Bitcoin access to clients, that represents round one. But when Morgan Stanley is basically using blockchain settlement rails for securities transactions, that represents a round two. Now, the benchmark analysis emphasizes that the regulatory clarity is a prerequisite for institutional integration because the institutions they can't commit to building on uncertain regulatory foundation. But once the market structure rules can clarify, institutions now can engineer long-term infrastructure commitments rather than maintaining a tactical crypto exposure through third-party providers. This is going to completely transform crypto from an investment product to operational infrastructure that's basically embedded in traditional finance workflows. So, Fidelity's analysis highlights an underappreciated structural development where 100 publicly traded companies now hold crypto on their corporate balance sheets. What starts off basically as one company's unconventional treasury strategy now has evolved into a broader corporate arbitrage opportunity. Let me explain. Companies with access to capital markets can raise funds at traditional finance interest rates, and then they can deploy those funds into Bitcoin. They'll capture the spread between their cost of capital and Bitcoin's expected appreciation. For investors unable to buy Bitcoin directly due to, say, regulatory requirements or investment mandates, they can gain exposure through corporate equities, providing indirect access to crypto returns within the traditional securities framework. The systemic implication extends beyond just individual corporate strategies here. These 50 firms collectively holding over 1 million Bitcoin, they really function as a distributed market maker, providing structural liquidity. When markets decline, these firms' willingness to hold rather than sell, it stabilizes prices. Now, when markets rally, their accumulated position, it limit upside volatility by providing a supply at a higher price. However, Fidelity goes into detail and they kind of note that there's a critical risk there. If these companies face financial stress, forcing them to liquidate their crypto holdings, this would create a downward price pressure precisely when markets are already under strain. The structural liquidity provision works smoothly during normal conditions, but they could amplify volatility during crisis periods if the corporate treasurers become forced sellers rather than strategic holders. So, Bitcoin's price history shows remarkably consistent 4-year cycles measured from peak to peak or trough to trough. With bull market tops in November of 2013, December 2017, and November of 2021, accompanied by some severe drawdowns. The current cycle sits right at the 4-year mark from November's 2021 top, and the recent price pullback raises questions about whether historical patterns will repeat. Now, some analysts argue the 4-year cycle is ending, suggesting that pullbacks will continue, future volatility will be substantially less, maybe less severe than some of the past bull markets. Others, they predict that a super cycle where the bull market extends for years without traditional cyclical correction, kind of similar to the commodities decade-long super cycle in the 2000s. Now, Fidelity also notes that the 4-year cycle is definitely due to repeat. We would need a confirmation first that the November 2021 represented the all time high for this cycle, and that now we've entered basically a full blown bear market. The current pullback could represent either the beginning of a new bear market, confirming the 4 year pattern, or simply a bull market drawdown similar to previous corrections within this cycle. The uncertainty itself signals something profound about the current market structure, though. In previous cycles, market participants understood they were in a bull or bear market with relative clarity. The current debate about this cycle basically, it suggests the market structure is transitioning from pure cyclical speculation driven by retail sentiment to a structural integration where institutional positioning creates different volatility dynamics that don't fit historical retail driven patterns. Okay, one last note to point out here. The benchmark in January 12th analysis, it identifies the current Senate session has potentially pivotal for digital assets. It's driven by expected movement, hopefully, on a bipartisan crypto market structure legislation. The significance here extends far beyond regulatory clarity for its own sake, but clear market structure rules that would allow institutions to commit engineering resources to building on crypto infrastructure for multi year operational integrations rather than just maintaining some tactical exposure through third party providers. This distinction matters. When institutions use third party custody providers or exchange services, they're basically treating crypto as an external asset class. But when institutions build direct blockchain settlement capabilities into their own operational infrastructure, they're treating blockchain as a foundational technology layer that's basically equivalent to the internet protocol or the current database systems that we have in the market. I hope that you enjoyed this session and have a good evening.